Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. As we've discussed before, we need to be up at this 30,000 foot level. We need to be looking at the economy in terms of what it actually is versus what a lot of the skeptics are sitting there talking about. So what we want to look at is the fact that so many people felt that we were going to go into a recession. Yet, when we look at it from the standpoint of the Seafried Brew Recession Threat Index, we've pointed to the fact that as you look at how this index reacted going above 50 into the Great Recession and then plummeting down after the Great Recession, giving some signals but still not moving over that 50 level back last year in the spring, where we said we did not feel the economy was going to go into a recession. Once again, looking at it, our reasoning that we're really not seeing any signals of a recession. So once again, up at that 30,000 foot level, that brought us through a period of time where suddenly this past Friday we're looking at GDP coming out in here. And when we look at the components of GDP, does this look like a recession is happening? No, it really looks from the standpoint when you look at the 2.5% growth that we saw in the second quarter, which of course much higher than the 1.3% in the second quarter, that a big piece of it was the consumer. The consumer was in there at 172 basis points of the 250. And that is a very good sign, especially because that comparison with consumer sentiment, etc., had been so negative in here. A lot of people might be saying that the reason that consumer sentiment is so skeptical is because of what is happening at the federal government and not being able to get either tax cuts, tax increases, spending cuts, spending increases together in here, created what you would call a skepticism on the standpoint of consumer, but the consumer was fully in there. We had the question asked last week about this. Is it a situation where this was because of higher prices? Well, in terms of higher prices, that was only about 8 basis points of the 172. So once again, strength on the consumer side, strength on the investment side, from the standpoint of the majority of the investment piece was due to buying technology, which I think is a positive. We look at, even though government contributed nothing to GDP at zero, that a good sign in here is that this was the first time in numerous quarters where this wasn't a negative number. This may be indicating that state and local municipalities, which made up a big part of the negatives that we've seen over this period of time, may be somewhat stabilizing in here, which could be a good sign. When we look at exports versus imports, is that we actually got a positive 0.22 from this time around. Once again, we had a positive 0.24 coming in the second quarter, but once again suggesting that our exports in here have been strong and continue to be strong, which has also been a big benefit for manufacturing. So where you might say 2.5% isn't setting the world on fire, at the same time, when we look at it, is that this is backing the thought process that we are not heading into a recession again. So when we come over in terms of looking at the states, we had released last week the state coincident indexes coming from the Federal Reserve of Philadelphia. And we like to look at this not only in terms of a piece of your economic risk based upon state economic risk, but we like to look at it from the standpoint of the entire nation. And within that is that green to dark green is a good positive growth. When we look at these sort of grayish areas, that would indicate basically a flat. When we look at red and into the pinks, that this would be negative growth. So when we look at the nation overall, and you look at the real incredible wealth piece of the nation, is that this tends to be in a growth pattern, which is really a positive. Along with positives that we've talked about in terms of Florida, which had been for so long in the red zone. And then we look at California, another problem area that has turned green, as well as down into Arizona. So when we look at this on an overall basis, this supports the fact of a positive GDP. We'll get the 6-month forecast, which really looks out over the next 6 to 12 months, coming in here this week. But from where we were last month is, once again, it was showing an overall positive growth rate for the majority of the states in our country. So when we think about this, what is going to be the impact to interest rates in here? Well, as we talked about last week, we haven't seen much of the twist in here. In fact, we reached up in here to a 240 on the 10-year just on Friday, when we, of course, got the GDP release. We also got fairly good numbers in terms of employment with the jobless claims, and we'll see how unemployment comes out this week. But look at it compared to the low in here, which was at the point where the Fed was coming in talking about Operation Twist, is that we've seen a move up of 70 basis points. We saw a move down in here today to around a 220, but still this kind of moves in the market are significant. Especially, surprisingly enough, just going back to August 1st. In August 1st, we had a high on the 10-year Treasury of a 2.77. It would suggest that this whole time period that we've been through has been somewhat like a twilight zone in here. Stock markets diving, looking at treasuries improving from the standpoint of getting to this kind of low. And now that we've come out of this, showing that we're not going into a recession, some improvement in terms of the European situation, you can see we've moved up. The question is that do we continue an upward move in here back to the 277 area, where we also saw the Dow Industrials over 12,000. This is Jay Brew, co-chairman of Seafried & Brew. Have a great week.